Hey guys, it's Crossroads here. Today I wanted to talk to you about volatility, specifically why I went in heavy in the pre-market and used up basically all my free cash. I do have some swing trades that I'll probably liquidate on Monday and go in even heavier into the market. But I want to talk to you about volatility. There are days like this morning and really this week where the stock market is tanking, and it's easy to just look around and say, okay, is this one of those times that I should just sell and wait for a better time to enter the market? Should I just hold on to what I have? Or when is the bottom? When should I actually buy? And no one can tell you when to do that or how to do that for sure. You need to determine what your comfort level is. I will say if you had problems with the volatility over this next week, it's okay to look at index funds and just invest in them. You'll do very well over the long term if you're investing in index funds like the S&P 500 and, of course, the NASDAQ. But what I was looking at this morning, of course, are two indicators. One told me a lot of information, and one told me a little bit, but it was actually more useful for the yen carry trade event back in August. Let me show you a couple of charts. So the first of these is the relative strength index, sometimes abbreviated as RSI. There's a few different ways to calculate the RSI, but basically what this is it's showing the strength of the upward movements over the last 14 days against the strength of downward movements over the next 14 days. And so it's telling you basically momentum in the stock market. So that's this tracker right here. This is on the daily chart, looking at the entire year that we've had. So basically year to date. And you can see, of course, it's the stock price has gone down and the relative strength index also went down. That's a normal thing. There are times when there's a divergence. That's something that technical traders oftentimes look at, and it does have its merit, but that's not what we're talking about today. So how is RSI usually used? In the simplest form, when RSI goes below 30, which is this dashed, I believe, green line right here, that's when it's conditions that's considered as oversold. In other words, usually when something like the S&P 500, and you could look at individual tickers as well, but it's most useful in the index, especially for days like this, when it hits that 30 mark, it's not necessarily an immediate bounce, but look at these. So just this year, we're in a bull market. Keep that in mind, and let me talk about that in a moment. But here it hit right around 30, and then there was a bounce. Here, of course, yen carry trade event hit actually just below 30, and it bounced. We see here it didn't quite hit. I actually thought we might have another day or two of this selling off, but thankfully the PCE came in and inflation was actually cooler than expected. So it gave us a bounce slightly early, but I don't always wait for the bottom on this, especially in a bull market. So when the RSI on the S&P 500 goes at or below 30, oftentimes people like myself are looking for a bounce. And so even if you don't believe in technicals at all, just know a lot of people believe in the RSI, a whole lot of people. It's probably the most favorite technical indicator of the vast majority of people in the market. And so it almost becomes a self-fulfilling prophecy when people are like looking to put in some funds. Now, in a bear market, I will say, and let's even look at that a little bit. Let me go out a little bit further. You can see that there's certainly times when it broke below the 30 and actually kept falling for a bit. In a bear market, or if there's a large and significant catalyst, like COVID was one of those, oftentimes that can mean that the RSI is overbought or rather oversold for a while and stays below it, but it does bounce. You can see that time and time again. Now, on the other side of the RSI, it doesn't come into a play as much today, but if it goes above 70, we call that overbought conditions. Now, in a bull market, just like you can see right here where it went over multiple times this year, usually a bull market will run up a little bit higher and a little bit hotter for individual equities, certainly, and especially, but also for the stock market as well, before they actually sell off. But that's usually a pretty good top indicator. You can see here back on December 4th, also on November 11th, we hit that. November 11th, of course, pulled back a little bit for a time as the RSI kind of reset, and then we kept climbing. And of course, you see that here, December 3rd, December 4th, took a little bit. And sometimes, especially in a bull market, if it's overbought, it's not going to sell off immediately, usually, unless there's a catalyst. Instead, it can be overbought for weeks, sometimes even months. We have a nice RSI cool down and reset right here. And of course, as we were near 30, that's what I decided to buy in heavy. Now, the other indicator, let's look back in August. You can see here, this is the yen carry trade event. That was the highest peak volatility. You can see all the volume, by the way, in that green bar. What a day. Pre-market, things were selling off the world was ending. And of course, RSI dipped down greatly, and we had an immediate bounce. It's actually quicker than I expected. The other technical indicator that's oftentimes used, and I think it's excellent in some cases, I look at both of these, is the VIX, Volatility Index. The VIX itself, let me just zoom out here. Over 5 years, you can see it can hover, around 20. In a bull market, it tends to be lower. In a bear market, it tends to be a little bit higher. And when things are crashing like COVID, it goes way, way up. If we zoom all the way out to max, there are a couple other events to look here, but anytime that you see it really peak, there's something really, really wrong, or at least the market thinks it is. So this, of course, is the 2008 crash. There was a flash crash here in 2011. There was another flash crash here. And of course, this was COVID. It doesn't show it because a lot of that happened in the pre-market. There are indicators that track the VIX, this is CBOEs, but they also include the pre-market. And at the time, on August 7th, in the year and carry trade event, we were in the 50s and 60s in the VIX. And I was thinking to myself, looking at these historical events, is this as bad as COVID? Probably not. I don't know how bad it was going to be. Thought it was going to be worse than it was. Is it as bad as a flash crash? There was actually legitimate reasons for the reason why the stock market sold off like it did in 2011. Is it as bad as the great financial crisis of 2008, which the VIX actually briefly exceeded in its peak? Oh, actually, it didn't quite go up to 80, but it was close. I was thinking certainly not. And so as a result, back on August 7th, because of the RSI, because of the VIX as well, I said, you know what? I'm going to go ahead and buy names that I really like. I also sold some cash secured puts on some names that I wouldn't have minded a cheaper price on. One of those was Palantir. Kind of wish I just bought more at 20, but I bought cash secured puts anyway, and I had a lot of Palantir anyway. But those are two indicators that will help you. Again, the RSI, look it up, research it a bit. Also the VIX. I also want to leave you with one other note. I know the market's stabilized, things are back up. Thankfully, all my free cash is in there. But some good advice from Peter Lynch. Evan posted this morning, and I thought that this was excellent. If you're a retail investor and you decide that you only want to listen to one investor, Peter Lynch is probably the guy to listen to. He has some great insights, and he has that also on pullbacks like this today.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
We'll leave it at that. Buy names that you find to be quality, that you can sleep like a baby holding because you know the direction that they're going long term. And not every stock is for every person. I had a HIMSS video recently. I talked about the immense volatility in that stock. That's not an appropriate investment for everybody. Just make sure after today, since things kind of stabilized, if you were stressing out, if you're freaking out because a certain stock you were holding was just tanking, reevaluate. Think to yourself, do I really need to own this name if anytime that there's a drop of 5, 10, 15%, I'm really greatly troubled? Peter Lynch actually goes on and talks about, some stocks that he had invested in that dropped 50% over some time. Warren Buffett has had some of those too. Berkshire Hathaway actually had multiple times where it dropped an obscene amount, even though there was nothing wrong with that company. So know what you invest in. Know why you're investing. Know if you're here for the long term or a short term trade. Invest in quality names and use indicators like RSI, like the volatility index, to tell you, like, hey, this is probably overdone relative to what's happened previously in history. Maybe it's a good time to buy. Let me know what you think in the comments. Did you add more over this week? Are you looking for a greater dip? I think we might get one in January. We'll have to see. Did you just kind of sit tight? Were you freaking out at the time and you kind of realized maybe you didn't need to do that? I'd love to hear it in the comments. I've been a new investor before. That's why I do these videos. I want to help somebody else that's maybe like struggling with how to think about this sort of thing. So appreciate you guys. And for now, happy and successful investing.